Scene script. Have you ever wondered how to make money while you sleep? This intriguing question has probably crossed your mind at some point, hasn't it? The allure of passive income, the thought of your hard-earned money working for you even when you're not actively engaged, is a concept that has gained much traction in recent years. The beauty of passive income is that it offers an opportunity to create an additional revenue stream. It's like having a tireless worker, your money, that doesn't clock out, doesn't take breaks, and doesn't ask for a raise. It's the idea of your money working tirelessly for you, round the clock, week in, week out, whether you're at your desk, on holiday, or even fast asleep. But how does one go about setting up this revenue stream? The secret lies in investing. Investing is the cornerstone of passive income. It's the process of allocating your resources with the expectation of generating an income or profit in the future. Investing for passive income is like planting a seed today and nurturing it over time so it can grow into a tree that bears fruit regularly. It's about putting your money to work today so that it can yield benefits in the future. It's about creating a source of income that keeps flowing, even when you're not actively involved. Now you may be wondering, what should I invest in? That's where exchange-traded funds, or ETFs, come into play. ETFs are a popular choice among many investors for their accessibility, diversity, and potential for both growth and income. But before we dive into the world of ETFs, it's important to understand that investing comes with its risks. It's not a guaranteed route to quick riches, but a strategic, long-term approach to growing your wealth. Now imagine earning money without lifting a finger. Sounds like a dream, doesn't it? Well, it's not, and we'll show you how. So, let's delve deeper into the world of passive income and discover how you can make your money work for you. To start your journey towards passive income, you need tools. One such tool is called an ETF, or exchange-traded fund. Now, you might be wondering, what is an ETF? Well, let's break it down. An ETF is a type of investment fund that is traded on stock exchanges, much like individual stocks. It's a basket of different assets, whether that's a collection of stocks, bonds, commodities, or a mix of these. This means that when you buy a single share of an ETF, you're essentially buying a small piece of each asset within that fund. Now, why would you want to do that? There are several advantages to investing in ETFs. The first is diversification. Because each ETF share represents a collection of different assets, you're spreading your investment across a wide range of companies or markets. This can help to mitigate the risk of a single company or sector performing poorly. The second advantage is cost. ETFs typically have lower expense ratios than other types of managed funds. This is because most ETFs are passively managed, meaning they aim to mirror the performance of a specific index rather than actively trying to outperform it. So you're not paying for a fund manager's expertise and time. The third advantage is flexibility. ETFs are traded on stock exchanges just like individual stocks, which means you can buy and sell shares at any time during the trading day at market prices. This is different from traditional mutual funds, which can only be bought or sold at the end of the trading day at a set price. So, to put it simply, ETFs offer a way to invest in a broad range of assets with one single purchase. They're a cost-effective way to diversify your portfolio, providing you with exposure to different sectors and markets without the need to buy each individual asset. ETFs provide an easy and cost-effective way to diversify your investment portfolio. It's like owning a tiny piece of a large pie. You understand the concept of passive income and what an ETF is. Now, how do you invest in them? First off, you should decide on an investment strategy. Are you looking for growth or income? Are you interested in a specific sector? Or do you prefer a broad market exposure? Perhaps you lean towards socially responsible investing. Once you have a clear idea of what you're aiming for, it will be much easier to narrow down your ETF choices. Next, you'll need to find a broker. In today's digital age, online brokers are a popular choice. They offer easy access, user-friendly platforms, and typically lower fees than traditional brokerage firms. When selecting a broker, consider factors like trading costs, the range of available ETFs, and the quality of customer service. Remember, this will be your gateway to the investment world. So choose wisely. Now comes the fun part, choosing the right ETFs. This requires some research. Look at the ETF's underlying holdings, its sector exposure, and its performance history. Check out its expense ratio too. This is the annual fee that the fund charges its shareholders. A lower expense ratio typically translates to higher returns for you. And don't forget about the dividend yield if you're aiming for income. Once you've made your choice, it's time to make the purchase. You can do this through your broker's platform. The process is similar to buying a stock. You enter the ticker symbol of the ETF, decide how many shares you want to buy, and place your order. You can choose to make a market order, which will buy the ETF at the current market price, or a limit order, which will only buy the ETF if it reaches a certain price. And there you have it. You've taken your first step into the world of ETF investing. Just remember, like any investment, ETFs come with risks. It's important to monitor your investments and adjust your strategy as needed. Investing in ETFs is not a complicated process, but it does require some strategic thinking and planning. So, how exactly do ETFs contribute to passive income? Well, let's dive in. ETFs, or exchange-traded funds, are like a basket of different stocks, bonds, or other assets. They provide a way for investors to diversify their portfolio without needing to buy each individual security. But here's where it gets interesting. ETFs can generate passive income in two primary ways: dividends and capital gains. Let's start with dividends. These are payments made by companies to their shareholders out of their profits. When you own an ETF, you become a shareholder in a myriad of companies, and thus you are eligible to receive a share of their profits in the form of dividends. These dividends can be a steady stream of income that continues to flow into your account, even while you're asleep. Now, on to capital gains. These occur when the price of a security within the ETF rises above the price it was purchased at. If the ETF sells that security, the difference is a capital gain. This gain is then distributed to the ETF shareholders. It's like a bonus on top of your dividends. But the magic of passive income doesn't stop there. Consider the concept of reinvesting dividends. Instead of taking the dividend payouts as cash, you can choose to reinvest them back into the ETF. This means you're buying more shares of the ETF, which in turn increases the amount of dividends you'll receive in the future. This is the power of compound growth. Your money gets put to work, earning more money, which then gets reinvested to earn even more money. It's a snowball effect that can significantly increase your wealth over time. So, in essence, ETFs allow your money to grow in multiple ways. They provide you with the opportunity to earn income through dividends and capital gains, and they enable your wealth to compound through the reinvestment of dividends. With ETFs, your money is not just sitting there, it's actively growing, and that's the beauty of passive income. We've covered quite a bit today, so let's recap. We began our journey by delving into the captivating world of passive income. It's the dream, isn't it? Earning money while we sleep, vacation, or simply enjoy a cup of tea on a lazy Sunday afternoon. It's about making our money work for us, not the other way around. Then we shifted our focus to exchange-traded funds, or ETFs, as they're more commonly known. We discovered that these are not some arcane financial instruments, but rather collections of stocks, bonds, or commodities that are traded, just like individual stocks on an exchange. They offer diversification, which is a key to reducing risk in investing. They are accessible, affordable, and can be a great tool in our financial arsenal. Next, we took a step-by-step walk through the process of investing in ETFs. We learned that the journey begins with setting financial goals, researching different ETFs, and selecting a brokerage. We also touched upon the importance of understanding the fees involved, as these can nibble away at our returns over time. Following this, we turned our attention to the role ETFs can play in generating passive income. We explored how some ETFs are designed to provide regular income streams through dividends or interest payments. These ETFs can be a fantastic way to supplement our income, fund our retirement, or simply help us build wealth over time. In conclusion, the world of passive income and ETFs is a vast and fascinating one. It's a realm where patience, knowledge, and the right tools can turn our financial dreams into reality. Remember, the journey to passive income isn't a sprint, it's a marathon, but with patience and the right tools like ETFs, you can make your money work for you.